But you just said something, and I want to follow up, Craig. You said markets are not worried about the debt right now. So what are we seeing all these sell-offs for then? I mean, is it just about 3%? Should we really be selling off 1,000 points because 3% on the 10-year?
I think it's all fund flows. And I heard last night that was just reported, and I hadn't seen the exact specific numbers, but I heard we had the largest outflow out of U.S. stocks in history. Which
why?
Is,
but why? Is it because 2.9% wage growth? Is it because of 3% on the 10-year? What's the catalyst here? Or is it just because we saw $8 trillion in gains and collectively you saw a market say, you know what, it's time to lighten up?
So many people have been, we've hit new highs, and people have been expecting this and, clamoring for it, like I said earlier. So when it comes, you're going to get some people that say, okay, now this is it. This time the market's going to sell off. And the market will sell off, but we look at it as an opportunity.
So it's the bond market that's really focused on the debt, Dig, and that's pushing rates up, and the stock market focuses on the higher rates.
Right, and I think that this just could be a mania exploding, a bubble bursting, and it was a bubble that was largely created by central banks around the globe. And there doesn't have to necessarily be a fundamental reason, but once it turns, it keeps collapsing and it gets ugly. And it's not just stocks. Yeah. It's a lot of other asset classes where you see this just delusional mania.
But Craig, I think what you're saying is it's not delusional because it's based on strong earnings and there's not a bubble in the stock market. Is that what you're saying?
The only bubble I see is in the ETF passive investing area. People have just done that because it's worked so well. If you see what inflows have gone into ETFs, it's crazy. They say 65, 70% of every dollar that comes in to the market goes to those products.
Well, how is that different than mutual funds? When you look at a pure vanilla ETF, I'm not talking about the volatility, shorting volatility. I'm talking about plain vanilla ETFs. How is that different than putting my money into individual stocks or mutual funds? It's lower fees. So what's the problem?
Most of the ETFs. Yeah, most of the ETFs are weighted towards the heavier, better performing stocks. So as money goes into these ETFs, they end up going on a larger percentage to the things that have done the best. So it's sort of a self-fulfilling mechanism, if you will. The reverse of that could be a little bit scary, and we're starting to see the very early parts of that.
But you also own ETFs, right?
No, we're an active, stock picking firm where we're looking for companies with superior earnings, superior growth rates, superior products, and we're not necessarily going to chase the stocks that have done the best. And that's what ETFs, by nature do. And so, if you see some unwinding of this ETF, it could be a little bit scary to the market on a short-term basis. But like I said earlier, the backdrop, the underlying things that are going on in the economy have never been better, and they've never been more positive. And ultimately, stocks move according to free cash flow and earnings. And that backdrop is better than I've seen in years and years and years.
But you're right. Most ETFs, the biggest ones in the world, are just like stock mutual funds. We're talking about the ones that we've been concerned with were the esoteric short volatility funds that are new to this market, that have come out since 2009.
And I didn't understand them when they first hit the market. And when I don't understand something, I avoid.
And the people buying them didn't understand them either because they just lost all their money on Monday night.
I'd rather just buy pure vanilla, and I know what I'm getting because that's really the fundamental backdrop that's so positive. 20% earnings growth and 4% economic growth in 18.
Yeah, and Craig, I hope you're right that that's what people are going to pay attention to here. But over the past week, all of those earnings stories have gotten lost. And so you're kind of betting people are going to get back to that. Will they really? I mean, and how soon will they get back to that?
Well, that's just it. I mean, I've heard on everywhere, man, we need a sell-off. I mean, you virtually get 5 to 7% sell-offs every year in the market. And we've almost gone 2 years without it. And now that it's here, you're going to get the weak holders panicking and seeing exactly what we're seeing now. And it could get a little bit worse. I mean, you could see another 2 to 5%. And if that's the case, look for those opportunities. Buy the great companies out there.
And at these valuations, is the U.S. your favorite equity market?
It is, because it's going to get better with these tax cuts. I think the other thing is the lack of equities. 20 years ago, there was 7,800 or so U.S. listed securities. That's been cut in half. There's like 3,600. So there's more money going after fewer opportunities here in the U.S. So yes, I think that, and I think that's why you're going to get multiple expansion ultimately.
And that continues if they keep buying back stock, which we're expecting after this quiet period ends after earnings. So that's right now they're not buying back stock, the corporates, because we're in a quiet period ahead of earnings. But that's going to come back in a couple of weeks. Craig, it is good to see you. Thank you for your insights.
Thank you.
Craig Hodges there.